Introduction to Stock Market. What is stock market? The stock market refers to the collection of markets and exchanges where the regular activities of buying, selling, and issuance of shares of publicly held companies take place. Why do companies come to share market? A company enters the primary market to raise funds. It is in the primary market that a company gets registered to issue shares to the public and raise money. Companies generally get listed on the stock exchange through the primary market route. IPO, Initial Public Offering, IPO, is the process by which a private company can go public by sale of its stocks to general public. It could be a new, young company or an old company which decides to be listed on an exchange and hence goes public. Companies can raise equity capital with the help of an IPO by issuing new shares to the public, or the existing shareholders can sell their shares to the public without raising any fresh capital. ASBA process facilitates retail individual investors bidding at a cutoff with a single option to apply through self-certified syndicate banks, SCSBs, in which the investors have bank accounts. SCSBs are those banks which satisfy the conditions laid by SEBI. SCSBs would accept the applications, verify the application, block the fund to the extent of bid payment amount, upload the details in the web-based bidding system of NSE, unblock once basis of allotment is finalized, and transfer the amount for allotted shares to the issuer. Applications supported by blocked amount, ASBA, is a process developed by the India's stock market regulator SEBI for applying to IPO. In ASBA, an IPO applicant's account doesn't get debited until shares are allotted to them. ASBA allows the investor's money to remain with the bank till the shares are allotted after the IPO. Only then does the money transfer out of the investor's account to the company. This eliminates the need for refunds on shares not being allotted. What is SEBI? Securities and Exchange Board of India, CBI, is the regulatory body for the stock market of India. It was established in 1992 under Section 3 of SEBI Act. SEBI has power to regulate all market intermediaries and also to penalize them in case of fraudulent activities and unfair trade practices. SEBI has the authority to regulate and develop the stock market. Objectives of SEBI: to regulate the activities of the stock exchange, protecting the rights of investors, preventing fraudulent and unfair activities, develop a code of conduct for intermediaries. Purpose of SEBI: the main purpose for which SEBI was set up was to keep a check on malpractices and protect the interests of investors. It was set up in order to meet the needs of three groups. Issuers, to provide a marketplace in which they can raise capital easily. Investors, to provide protection and supply of information. Intermediaries, to provide a competitive professional market. List of exchanges in India. 1. NSE. The National Stock Exchange, NSE, is the leading stock exchange of India, located in Mumbai. It was established in the year 1992 as the first demutualized electronic exchange in the country. NSE was the first exchange in the country to provide a modern, fully automated screen-based electronic trading system which offered easy trading facility to the investors spread across the country. 2. BSE. The Bombay Stock Exchange, BSE, is India's and Asia's oldest exchange, which began 140 years ago under a banyan tree. It was India's primary exchange till the emergence of the NSE. Evolving from an open outcry system, the BSE also shifted to electronic trading mode in a record 50 days. With increased connectivity, the BSE was the first Indian exchange to launch mobile trading in 2010. Despite being 140 years old, the BSE is India's fastest exchange with 6 microseconds. There are few more exchanges in India which are not so active in the market.